Hey everyone. So people just completed their new taxes under the new tax rules, and so they're just starting to get their hands around what the new rules are and how it will affect their investments and their after-tax yields. Some of the most significant areas of change for the new tax laws were the pass-through deduction, accelerated depreciation, and opportunity zones. So with the pass-through deduction, active investors can reduce their income by 20%. So basically, if you made $100,000, you only pay taxes on $80,000, and you can do that through commercial real estate investments. But there are limitations, first of which being that the investor has to be active. They have to be active investors involved in the day-to-day decision-making on their properties. They have to spend at least 750 hours on those investments, and they have to be actively involved in those properties. The deductions phase out once you hit certain income levels, and depending on payroll and the business size and the depreciable assets in the portfolios. Also, they don't always apply to passive income and some assets like perhaps net leased properties. Active investors can capitalize on the pass-through by increasing their real estate basis. Basically, they can increase the size of the limitation by having more and more real estate. Accelerated depreciation is probably one of the biggest advantages that came through in the new tax reform. And there's two provisions for accessing the accelerated depreciation. The first is that properties purchased after September 27, 2017 can accelerate the depreciation on personal property associated with those assets. So basically things like the roofing, the HVAC, anything that would be depreciated over 5 or 15 years can actually be depreciated and expensed in the first year. In order to really take advantage of this, you need a cost segregation to break out the personal property from the real property and be able to write that off. And what that does is it boosts the cash flow during the early stages of ownership. Now, there's another way to use accelerated depreciation, which is through the Section 179 ruling, which allows full expensing of up to $1 million of business assets, including furniture, HVAC, etc. And this is really a popular provision for hotel investors. So basically, there's two ways to increase your depreciation, and both of them will boost your cash flow in the early years. But remember, you're going to have to recapture that depreciation when you sell the asset. The third big feature of the tax reform that investors are looking for information on is opportunity zones and opportunity funds. The Treasury Department just released 169 pages of new opportunity zone guidance last Wednesday. So tax experts are in the process of analyzing the new rules. We'll deliver some insights on what this means for investors very soon. So what should investors do? They really need to have an investment strategy that factors in tax consequences into their strategy. So people should be talking to their accountants, especially accountants who specialize in real estate, to get a handle on ways that they can improve the performance of their after-tax returns. The recent drop in interest rates is another great opportunity. Because you have the mortgage interest deduction still, you can boost your positive leverage and generate stronger after-tax yields. And finally, consider accelerated depreciation, particularly by stepping up your basis in your portfolio, acquiring new assets, and then using cost segregation.